Chapter 15. This is the last chapter in the unit. This chapter focuses on retirement and estate planning. Retirement. How much income do you need when you retire? Do you keep the house that you have lived in for years, or do you move? What type of strategies do you use with regards to investing? How much insurance do you need? How do you beat inflation? These are all very valid questions that everyone must consider when thinking about retiring. Two different accounts that you can open are called individual retirement accounts. One style is the traditional and one is the Roth. They are very similar, however, they have one big difference. The difference lies with how the money is taxed when you contribute to it during the year. With a traditional IRA, you contribute the money to the account before you have paid income tax on it. So that money goes into the account tax-free. However, when you withdraw the money during retirement, you pay income tax on all of the money that you withdraw. The opposite of a traditional is known as a Roth IRA. When you contribute to that account, you contribute money that you have already paid tax on now while you are working. But when you retire and you start withdrawing money from the account, you do not pay tax on any of the withdrawals. So, to repeat again, with a traditional, you contribute money pre-tax. So if I had a traditional IRA, the money would go in before any income taxes are imposed on the money now. As that money grows over the years, it will grow and grow and grow. When I go to withdraw that money from a traditional IRA account, I have to pay tax on every penny that I withdraw. The Roth IRA, any amount of money you contribute now is contributed after you have already paid tax on it. So it is contributed based on my net income. I have already paid taxes on it. That money will grow and grow and grow and grow. And when I'm ready to retire and I want to withdraw the money, I withdraw every penny from that Roth IRA without paying any income tax on it. Two very important accounts to think about. These accounts are accounts that you can open up on your own. They are not associated with a company that you will work at. These are individual retirement accounts that you as an individual investor can open. Two other styles of retirement accounts are the defined benefit and the defined contribution plans. The defined benefit is most commonly known as a pension. These accounts are very rare, and with a pension, the employee puts in a certain amount of money as the employer puts in a certain amount of money into that account. Once you have worked for a certain number of years, it may be 5 years, it may be 10 years, you then are entitled to the full amount of that defined benefit plan. The opposite is a defined contribution plan. So if you think about it, this is a contribution. This is what you're contributing to it. These are most commonly known as your 401k and your 403b. You put all of your money into, you put all of the money that you want to put into these accounts. They can be opened up in conjunction through your employer. Sometimes employers will do what's called a match. So they may do a dollar for dollar match. meaning if every week you put in $50, that employer will put in $50 into your 401k. Financial experts always say you should put in as much as the employer is willing to match. So if the employer says that they will match dollar for dollar up to 7% of your contributions, you should be putting in 7% of your income into that 401k. That 7% is free money from your employer. A 403(b) is another style of a defined contribution plan. These plans you can invest in various stocks, mutual funds, ETFs, bonds, anything you want, and then you can withdraw it when you retire. What is a 401k plan? This is the defined contribution plan. I highlighted this because this is the big differentiating point. These are a defined contribution plan for employees that work at companies that operate for a profit. Okay, so 401k plans are defined contribution plans for-profit corporations and companies. Some of the characteristics is that employees contribute a percentage of the wages. Usually you may say you're going to contribute 3%, 5%, what have you. It will usually be a payroll deduction, so this will come out pre-tax, so this will come out of your gross income. There's a wide variety of investment choices within 401k plans. And like I said previously, the matching contribution, if the company is willing to match, you should really contribute the maximum of that match amount. If you still want to contribute more towards your retirement, experts say you should then open up a IRA account, an individual retirement account, which I previously spoke about. The other defined contribution plan is the 403(b) plan. These are established for nonprofit organizations and government units. These are very, very similar to 401k plans. The biggest differentiating point is that a 403(b) is for a nonprofit, whereas a 401k is for a for-profit. So these are the majority of companies out there are a for-profit. They're operating to make money. They will offer a 401k. A nonprofit or government agency will offer a 403(b) plan. Estate planning. This is something that nobody wants to talk about, but everybody should have an understanding of what is involved with estate planning. An estate is everything that a person owns minus the debts that they owe at the time of a person's death. So estate planning should be done years in advance so that the transfer of the property at the time of death is a smooth transfer. Obviously, the goal of proper estate planning is to minimize the amount of taxes paid on the estate. You want to know, as you are getting older, where your possessions are going. So this is involved in estate planning. With estates come wills. Wills is a legal document that states how the estate will be distributed when a person dies. In every will, you have to name an executor. This is the person that is basically in charge of your will. They are the person that will carry out your wishes. You should usually just have one executor on your will because, as the saying goes, too many cooks in the kitchen makes it a little bit messy. So one executor to carry out your wishes. Here's just a couple of types of wills. A simple will just be a simple short document that lists out who your heirs are and what you want them to receive. A holographic will is a handwritten will in the person's own handwriting. A lot of times a handwritten will is not legally valid. As this bullet point states, only 19 states consider them a valid will. If somebody dies without a will, they are said to be intestate. And then when that happens, how things are distributed is according to the laws of the state where the person lived. So if something happens and somebody suddenly dies without a will in New Jersey, that person is said to be intestate, and how their estate is distributed is up to the state of New Jersey. Codicil is a legal document that modifies or changes parts of the will. So that this is the way that you modify or change your will. Remember, a will cannot be changed just by you crossing things out and writing new items. You have to legally change a will using a law professional. An heir is a person that will inherit property from somebody's estate when they die. Typically, heirs are spouses and children. When it comes to estate planning, everyone wants to consider the taxes that are involved. There's taxes when the property transfers from the estate of the person who passed away to the heirs. With proper estate planning, one of the goals is to minimize taxes. Estate taxes are paid based on the asset's value before the estate is distributed. So the taxes will come out first, and then the value of all of the assets will be distributed. There's both state tax and federal tax when it comes to estate planning. State tax will vary from state to state, and it can vary by the relationship of the heir to the person who passed away. For example, in Pennsylvania, money inherited by a spouse is not taxed. However, a transfer to a lineal descendant, such as a child, is taxed at 4.5%, siblings 12%, anybody else is 15%. Gift taxes. A gift tax is a tax imposed on a monetary gift during a given year. There are limits. For example, if you have a very, very wealthy relative, they could give you a gift each year up to $14,000 without paying any taxes on it. Once you go over that $14,000 marker, then there's tax imposed on it. There's a limit of $4.5 million during your lifetime before you must pay the gift tax. So if you think about it, that's a lot of $14,000 to equal that much. Federal state income tax. Taxes must be made on your income for that year. The executor, once again, the person who's responsible for carrying out the will, or the attorney, is the responsible party for paying all federal and state income taxes on that will. Estate planning is not a fun subject to talk about. However, it must be done so that the estate is distributed and transferred smoothly to who it is deserved to go to. That's all for chapter 15. Have a nice one.